Glad you're here. If you have a traditional IRA or a 401k, you have been leaving alone because you do not need the money yet. There is a forced move coming that most people never see until it is too late to stop it. On the morning you turn 73, the IRS stops letting you leave that account alone and makes you start pulling money out of it. That forced withdrawal can be big enough to shove your income over a hidden Medicare line, and crossing that line triggers years of higher premiums stacked on top of the tax. By the end of this video, you will know the one legal move that shrinks the withdrawal before it ever happens. For a lot of people, missing it runs past $50,000 over 5 years from an account that did nothing but grow. Here is why this matters right now. The first big wave of Americans born in 1953 turns 73 in 2026. That is the very first year the government requires them to start emptying these accounts on a schedule. Close to 4 million people are walking into it at once, and almost none of them know that the size of that forced withdrawal is what springs the trap. Every year you wait, the account is bigger. A bigger account means a bigger forced withdrawal, and a bigger withdrawal is exactly what pushes an ordinary retiree over a line that costs real money. The time to do anything about it is the handful of years before that birthday, not after. Before we go further, hit subscribe and turn on notifications. The IRS does not call you when a rule changes. Medicare does not warn you before it raises your premium. These income thresholds shift every year, the deadlines pass quietly. By the time most people find out, the trigger has already happened, and the door has closed behind them. What I do on this channel is read the actual statute, tell you what your advisor never got around to. Let's start with the move that catches people first. At 73, the government stops letting you leave that account alone. The rule is called the Required Minimum Distribution, the RMD, and it is exactly what it sounds like. The IRS makes you pull a slice out of that traditional account every single year and pay tax on it. You spent decades being told to leave it untouched and let it grow. That advice has an expiration date, and the date is your 73rd birthday. Why does government force this? Because every dollar in that traditional account went in without being taxed. The government always treated it as a tax bill. It agreed to collect later. On its own schedule, 73 is when later arrives. They are not asking. The size of the slice is set by a number the IRS publishes, and at 73, that slice works out to a little under 4% of the balance in the first year. Most people hear that and think, a little under 4%, that sounds harmless. Watch what it turns into on a real account. Picture a balance that has grown to about $1,100,000 by the time that birthday arrives. The first forced withdrawal on that balance is around $41,500. You did not ask for that income. You may not need a single dollar of it, but it lands on your tax return all the same, and at a 22% rate, the tax on that one withdrawal is about $9,000. $9,000 in tax is a real hit, and most people brace for it. The tax is the part you can see. The cost that does the real damage is the second one, and almost nobody sees it coming, till the bill shows up 2 years later. That second cost comes from Medicare, and it goes by the name IRMAA, the Income-Related Monthly Adjustment Amount. Here is the part that ambushes people. Your Medicare premium scales with your income. The more you report, the more Medicare charges you for the exact same coverage. And that forced withdrawal you just took, the one you never wanted, counts as income. Now here is the cruel piece, and it is all in the timing. Medicare does not look at this year's income to set this year's premium. It looks back 2 years. So the big withdrawal you take at 73 does not raise your premium at 73. It raises it at 75. Long after you have forgotten the withdrawal even happened, you have no idea why your Medicare suddenly costs more. People call the office, swearing nothing changed. Something did change. It changed 2 years earlier, and they did it to themselves without ever knowing. You might be thinking, this still does not touch you, that your income is modest and nowhere near some rich person threshold. That assumption is exactly what makes the trap so quiet, so let me show you the actual line. For a single person in 2026, the IRMAA threshold sits at $109,000 of income. Cross it by $1, and the surcharge kicks in. This is not a gentle ramp, where a little more income buys a little more premium. It is a cliff. $1 over the edge, and the full surcharge lands at once. Here is how an ordinary retiree sails right over that edge without trying. Say your income before the withdrawal was about $68,000, Social Security, plus a small pension. Comfortably under the line. You feel safe. Then the forced withdrawal of $41,500 stacks on top of it. Add the two together, you land at roughly $109,800. You cleared the cliff by $800 of income you were forced to take because it is a cliff that $800 costs you the entire surcharge. Your Medicare climbs about $96 a month across Part B and Part D together. That is roughly $1,100 a year in extra premiums sitting on top of the $9,000 in tax for a withdrawal you never wanted in the first place. You might wonder, if this trap is sitting right there in the open, why has nobody warned me? Because no single person is responsible for warning you. Your account custodian's job is to calculate the forced withdrawal, not to tell you what it does to your Medicare. Medicare's job is to bill the surcharge, not to explain that an IRA withdrawal is what triggered it. The two systems do not talk to each other in any way that ever reaches your kitchen table. The withdrawal lives in one agency, the surcharge lives in another, and the gap between them is exactly where your money falls through. It is simply what happens when two rules, each reasonable on its own, land on the same person, and nobody owns the warning. Run it forward and it gets heavier. The forced withdrawal does not happen once. It comes every year, and the required slice grows a little as you age. 5 years of tax on those withdrawals, plus 5 years of Medicare surcharges trailing 2 years behind them, and you are looking at more than $50,000. That is roughly 5 years of heating and electric bills for an Ohio home. Gone, pulled out of an account you were proud of, by a rule nobody ever explained to you. So the real question is no longer whether the trap is real. It is whether there is a way out. There is, and it is hidden in the same tax code that built the trap. The catch is that it only works if you move before that 73rd birthday. The years between the day you retire, the day you turn 73, are the most valuable window you have. Most people let them slip by empty. The move is called a Roth conversion. You take a piece of that traditional account, say $30,000 in a year, and you move it into a Roth. You pay the tax on that piece now, at today's rate, on your own terms, instead of the government's. Here is why that matters so much. Every dollar you move out now is a dollar that is no longer sitting in the account, growing toward that giant forced withdrawal later. And Roth money carries no required withdrawal, ever. You are draining the trap one bucket at a time, before it can ever spring. A lot of people assume conversions are a rich person move, something for people with an accountant on retainer. The opposite is closer to the truth. The years to convert are the lean ones, after the paycheck stops, before the forced withdrawal starts, when your income is low, and there is room under the next tax bracket to move money cheaply. That low income window is the gift, and it closes the day the RMD begins. Watch what it does to the numbers. Take that same person. Instead of leaving the account alone, they convert $30,000 a year for the 8 years before 73. By that birthday, the traditional balance is around $790,000 instead of $1,100,000. The forced withdrawal drops to just under $30,000. Their income at 73 lands near $98,000. That is under the $109,000 line. No cliff, no surcharge. Same person, same account, two completely different retirements. And the only difference is that they started moving money before the clock began. Now, what if you are already past 70 and that conversion window is short? There is a second exit You only need to be 70 and a half to use it. It is called a Qualified Charitable Distribution, a QCD. You can send money straight from your IRA to a charity, and here is the key. That transfer counts towards satisfying your forced withdrawal for the year, but it never shows up as income. It does not touch your Medicare line at all. If you already give to a church or a cause, routing that gift directly from the IRA instead of writing a check can keep the withdrawal from ever pushing you over the cliff. One thing to know, the money has to go straight from the IRA to the charity. The moment it passes through your own checking account first, it counts as income, and the trick is gone. There is one more reason not to sleep on these gap years. Conversion has to happen before your first required withdrawal year. To do its real job, the 2-year Medicare lookback means the income from each conversion follows you for 2 years. So the earlier you start and the more measured you go, the softer it lands. Cram 8 years of conversions into one. You create the very income spike you were trying to avoid. Spread thin over the gap years, the same money moves with almost no damage. Let me show you how this plays out for one person. Earl Novak spent 32 years as a postal supervisor in Ohio. Same loading dock, same coffee machine, the whole career. He did everything they tell you to do. He maxed out his retirement contributions starting in the late 1990s. He paid off his mortgage 3 years early, and he never once touched the account, not in 32 years. He was fairly sure there was about $640,000 in there. He never looked too closely at the statements. After his wife passed, he filed his taxes as a single person, which quietly cut his Medicare income line in half, compared to a married couple, though nobody mentioned that to him either. Earl thought of that account as a gift waiting for him at 73. He had the birthday backwards. It was not the finish line, it was the starting gun. By the time he reached it, his balance had grown past $1 million. The forced withdrawal landed. His income crossed the Medicare line by a few $100s. The tax he had braced for. The Medicare bill that showed up 2 years later, he had not. He spent a week on the phone trying to find out who had raised his premium. His daughter Karen, a nurse in Columbus, watched a video like this one and called him. The only fix still open to Earl was the charitable transfer, because his conversion window had already closed. Had he started converting at 65, the cliff would never have entered the picture. The difference between those two versions of Earl was 8 years he never knew he was supposed to use. So let's bring it together. At 73, the IRS forces you to start withdrawing from your traditional account, and that part is not optional. So the action is to know the exact age your withdrawals begin, and roughly how big that first one will be. That withdrawal is taxed, but the tax is the part you can see. The hidden cost is IRMAA, the Medicare surcharge that looks back 2 years and lands as a cliff. So the action is to find where your income sits against the $109,000 single filer line before the withdrawal stacks on top. The escape is the Roth conversion in the gap years before 73. So the action is to look now at moving a measured slice each year, while the window is still open. And if that window is already short, the charitable transfer after 70 and a half does the same job. So the action is to route any giving straight from the IRA to the charity. Every one of these only works if you move before the trigger event has already happened. None of this comes looking for you. The IRS will not warn you the year before. Medicare will not explain the surcharge when it hits. The forced withdrawal is coming on a date that is already set, and the only thing standing between it and your money is a move you make in the years before it. Subscribe and share this with someone who has an IRA they have been proudly leaving alone. A parent, a neighbor, a friend near retirement. One conversation could save them a house payment a year. I'll see you in the next one.